Hi, I'm Juliet Schooling-Latter from Fund Calibre, and today I'm talking to Chris McGoldrick, Deputy Manager on the elite-rated Stewart Investors Asia Pacific Leaders Fund. Chris, thank you for joining me.
Thank you very much for your time.
This fund has always had a strong bias towards companies that have good governance, where stakeholders are treated fairly. And it also has a bias towards sustainable companies. Is this an ESG type filter without explicitly being ESG? Can you tell us a little bit more about this, please?
I think you could say that, but it stems very much from our history and heritage. 30 years ago, our founder, Angus Tulloch, developed an investment philosophy, which was very much centered on equality to all stakeholders, the environment, the community, and obviously minority investors or debt investors, all treated in equality. And that is very much how we think of sustainability. It's treating all providers of capital in an equal and responsible fashion. Because of that, I think we've been looking at ESG for the best part of 30 years. We've been studying it as studiously as we study the notes to the balance sheet or to the cash flow statement, because it's a real mark of a company's quality and integrity, ESG. If they're disrespectful to their community or their employees or the environment, then there's every chance they'll be disrespectful to you as a minority investor. And sadly, in Asia, there's lots of opportunities to be disrespectful. And one of the ways that we've guarded against that and protected clients' assets from that sort of abuse is to study ESG in a very studious way.
And Stewart Investors has also in the past favoured family-owned businesses. Can you talk us through some of the pros and cons of a family setup and how it can influence the fate of a company?
Yes, and you're right to highlight that there are cons as well as pros. The famous Ambani family in India, case in point, where the two brothers fell out and have hurt minority investors in the process of that fallout. We like family businesses, though, because we feel that there's a large alignment. What we're trying to do with our portfolios is preserve capital and grow it for future generations. And that's really what families are trying to do. They're just trying to hand over an enlarged amount of purchasing power to the next generation. So that alignment means that they're thinking along the same sort of time scale as us, i.e. sort of 10 years. When we look at a business, we're trying to think about how it might look out in 10 years' time. One of the characteristics of family-owned businesses in our portfolios is that you'll find that about 70% of the businesses in Stewart Investors portfolios tend to have net cash balance sheets, i.e. a very low acceptance of debt or financial risk. And that is one of the main attractions. They also have an ability to think longer term, so they're not prioritizing short-term profitability or 1 year's profits at the expense of putting the company in a stronger footing for the future. So they are willing to maybe take a step back in order to go forward, which is not the case for many large free float businesses or state-owned enterprises.
And looking more specifically at where the fund is invested now, I see that there's a big overweight towards Indian and Japanese companies, but only a very small amount in China. Can you talk us through why you are or aren't finding opportunities in these countries?
I think the first thing to say is that our country weightings are purely an outcome of bottom-up stock selection. We start constructing a portfolio with a blank sheet of paper and pick the highest quality companies that we can find to populate that portfolio. We have traditionally found it easier to partner with companies in India. There's more family businesses that the government has very little influence over, and a strong quality people franchise and financials tend to be more abundant in India than the contrast in China, where the state is heavily involved in the economy, and you'll find that companies tend to be more highly indebted, as a generalization, obviously. More recently, or over the last sort of 3-4 years, we have found similar characteristics from companies in Japan. Now, these businesses may well be listed there, but actually the majority of their operations are in Asia Pacific, whether it be Nippon Paint, which is one of the largest paint brands in China, or Unicharm, which is a provider of diapers for the young and old, has a very strong China and Indonesian business. So whilst they might be listed in these countries, we think more in terms of economic interest, i.e. where the cash is actually coming from. And therefore geographic weightings can be somewhat misleading.
Right. And in terms of sectors, you've got an overweight to consumer staples and healthcare companies. So why those sectors in particular?
Again, it's very much a residual of bottom-up stock selection. We've long been attracted by what we call high-quality financials, which tend to be very predictable in nature, not too complicated. No use of derivatives or peculiarities. And we find that they tend to reside more in the consumer staple and healthcare sector than perhaps, say, the banking or technology centers or sectors. And for that reason, we have had or found higher quality companies in those areas, and the outcome of being overweight consumer staples and healthcare is purely that. It's purely an outcome. It's purely as a result of finding good quality companies that we want to impart our clients' savings to.
And another sector is technology, where you have an overweight, which is quite a sort of topical sector. Investors are sort of split on this area. Some see it as a huge growth opportunity, and others are worried, particularly at the moment, about China and the impact of US trade wars. What's your take on the sector, and does the trade war concern you?
Well, I think it's very important to distinguish that in Asia, we broadly have 3 different types of technology. In China, there's obviously the internet companies, most famously in the form of Alibaba, Tencent, or JD.com. In Taiwan, we tend to have the hardware providers, so the manufacturer of the components that are used by those companies, whether it be semiconductor chips or battery components or very basic any component for your laptop or cell phone. Then in India, we have software services businesses, which is computer coders that's making use of the hardware to effect more efficiency in businesses. And we have no ability to predict fashion trends in technology. So we don't sit and think, what will be the next best-selling phone or the next device that's really going to take off. Instead, we prefer companies that are providing the components and not taking that fashion risk, if you like. So that has drawn us towards businesses in Taiwan, which we're very pleased to find that it's quite hard to find a business in Taiwan that has a lot of debt. They're very financially responsible, very cost conscious. And a lot of that's the history of that economy. They have to be very resilient. Similarly, in India, the software services businesses such as Tata Communication Services has something like $6 billion of cash on its balance sheet. So it can take advantage of weakness to acquire businesses, to what, as we call it, allocate capital in when valuations are low. Where we are not invested is the Chinese internet businesses, primarily because of governance reasons. The legal underpinnings to these businesses have been a cause for concern. in addition, we have some concerns over the franchises and sort of fashionable nature of some of their products, particularly gaming. We're not particularly keen on the unpredictability of gaming. Then, when it comes to trade wars, obviously it's another concern. We very much think of our clients' savings as I said, we have a focus on preserving wealth, and that tends to mean that we focus on what can go wrong in the belief that what can go right, it takes care of itself. So if you avoid the worst injustices, then it's a recipe for preserving capital better in the future. And we just have to sadly add trade wars and US and Sino indignation to each other onto that list. It's probably quite telling that we're coming up to a US election, and it's quite a good way to divert attention from poor domestic policies by focusing on an external threat. And in the same way, I think there's criticisms and worries in China about the way that they've dealt with COVID. So ratcheting up rhetoric between a foreign entity can be a good way of diverting attention from poor domestic policies. So unfortunately, it's something that we're probably going to have to live with for some time.
Thank you for chatting to me today. For more information on Stewart Investors Asia Pacific leaders, please go to fundcalibre.com.